This is the fourth video in the series about Federal Reserve system policy, and this lecture covers the all-important connection between open market operations and interest rates. As a note of interest, this will be the last video posted before the quiz for this section is posted, which will happen the evening after I post this video. And that quiz will cover only the material about the Federal Reserve System that we have covered up to this point. I still have to post up a couple of lectures about Federal Reserve current policy, but given the hectic nature of the wind down of this semester and the peculiar circumstances under which we're trying to operate, those will be posted after your grades have been posted. I decided to do that for two reasons. I'm simply running out of time. For one, it takes a long time to put these lectures together in the way that we're doing here. But more important, I think that if I had posted the material on qualifications and current operations, that would have made the material much more difficult for you to digest in a short period of time. And I think you would have found the quiz more difficult because it's a step up in terms of the complexity of what we're describing here. So we're going to have the quiz simply on these first four that we've posted already up to this point. There will be a later posting that brings us really up to speed and talks about the modern era, but that's not going to happen until early May. And of course, you'll have your grades by then or nearly by then, and you won't have to worry about it. I'm not going to quiz you about it. If you're curious about what remains, then you can watch it. If not, and you want to get on with your new life, then you can do that just as well. So we're going to conclude with this temporarily and then bring the new material back after your grades have been turned in. Let's get into this. You remembered that open market operations, of course, clearly increase reserves and by so doing, increase lending, which results in the creation of money and credit. That was the point of the last open market operation. This video is going to point out that the very same open market operation also has the effect of decreasing interest rates. So actually we have these three beneficial effects: an increase in the money supply or credit and a decrease in interest rates. We have seen this already before in the aggregate supply, aggregate demand model, and in macro-sem. We saw how increasing the money supply can have a stimulating effect upon the economy because it shifts aggregate demand to the right. We obviously saw it in the loanable funds model and in macro-sem as well. Let's in fact review what we said about the loanable funds model. Not everything that we said, but two important points. We had scenario one where we curbed inflation by raising interest rates. And so in the case of that, the Federal Reserve slows down or stops the pace of open market operations, which reduces the supply of credit and raises interest rates. We didn't show an example of that in open market operations, but if they ran a reverse open market operation and sold rather than purchased Treasury securities, it would have this effect. And to some extent, this argument has to be qualified because even that's a bit of an oversimplification, but not too much of one. What we're mostly interested in the period where inflation is not a threat is what we're calling scenario two here, where the Fed stimulates the economy by reducing interest rates and in fact potentially reducing interest rates by close to zero. In this, you can see that they increase the scale or the pace of open market operations, do larger open market operations. That allows them to increase the supply of credit and lower interest rates, as is shown here. But we do have to raise a question about which interest rate we're talking about, because we'll see that it starts with the federal funds rate and certain U.S. Treasury rates, but does not necessarily initially apply to all interest rates. So that's going to be a little complication that we explain later in the exposition. Now, so far, again, up until the last lecture, when we said the Federal Reserve System increased the supply of funds, we never said how they did it. Now you know how they do it. They do it through open market operations. So now we understand the mechanism that shifts the supply of funds line from SF1 in this diagram here to SF2. Let's take a look at scenario 2 also in the macro sim model. So let's bring that back up. This, you may recall, was the default for the model, where we had the money supply or credit growth rate at 5%. In the default settings for that model, we had government spending at 600, and we had a 20% tax rate, and national output was in equilibrium at 2,800. So then, after that, we increased the money supply or the credit supply. Notice we're not being very specific about that because we kind of have a choice as to what we want to measure, to, in this case, 6.5%, without changing anything else. It's very clear that this has a stimulating effect upon the economy, because not only is it the case that we have an increase in GDP from 2,800 to 2,824, almost everything else is beneficially increased as well. For example, consumption is increased, as we can see here. Interest rates are decreased, and that has the effect of raising investment, as we can see here. But the budget the budget deficit also declines from 40 to 3509, and that's because, of course, this has stimulated GDP, which in turn raised tax collection. As you can see in the line above, taxes collected rises from 560 to 564, so even the budget deficit falls in the face of a stimulating money supply. So it's very clear that open market operations have the potential to strongly stimulate an economy by these examples. But we need to ask a couple of questions here, because open market operations generally buy U.S. Treasury securities, as we saw, that is to say U.S. Treasuries, bills, notes, and bonds. It is easy to see how those purchases can affect the yields on those assets. The heavier the purchases, the lower the yields. Also, because banks are able to lend more, then it's also easy to see why bank lending rates might decline in the face of aggressive open market operations. But how can open market operations affect other interest rates, like corporate bond rates or mortgage rates or auto lease and loan rates, for example? Because the Federal Reserve System traditionally has not bought those, although in recent years they have bought mortgages. That's something that will be explained in the lecture that makes qualifications to the original open market operations. We need to understand how this works by talking about this market that we've once brought up before but haven't said much about, but now it's time to focus on what we said. The federal funds market is a very large market that not many people know about. At the end of the business day, remember, banks have to have adequate reserves to justify their lending, and it is I keep hitting the forward on this with the knuckle of my hand. Let me move my setup here a little bit so I stop doing that. Okay, back to the lecture. At the end of the day, some banks have excess reserves given their lending and their deposit liability position for the day, and some other banks have reserve surpluses. Some banks have heavy lending shortages. Because the Federal Reserve System provides reserves simply to whatever bank is engaged in open market operations, and that tends to be a relatively restricted number of banks, there has to be a way for these reserves to be distributed around the country to keep this system running a little tighter. So, in this market, excess reserves from one bank to the other are lent overnight on a very short maturity loan, and sometimes that's literally a 24-hour loan. And the interest rate charged is the so-called federal funds rate, always expressed as an annual rate, even though the loan is often an overnight loan. Now, I should add a footnote to say that this market right now and this system isn't working as well as it used to, and isn't quite integral to what's happening in 2020 because of changes made to the system in 2020 and in previous years. But this has been important in the past, and it's likely to be important again sometime in the future. And the federal funds market is still, nonetheless, a legitimate market. Whereas you may know, if you remember, that the federal funds target rate right now is between 0 and 25 basis points. So that market still is an important market, and this is still how it works. The effect of all of this is to keep the system at a national level running very tight. So remember, the Federal Reserve Bank of New York, in their open market operations, doesn't conduct them with every bank in the United States. They conduct them with a relatively small handful of banks. Sometimes they conduct them only with banks that are called primary dealers, and that's a list, I think, of about 18 or 20 banks or so. So how does a smaller bank in the western United States get excess reserves? Well, they can borrow them from these New York banks that have excess reserves, and they pay the federal funds rate. And that's an overnight lending operation, except sometimes it's a little bit longer maturity. There's a national market for this, and generally, historically, funds have been transferred from smaller retail banks to the nationals and from the interior to money centers. Now, it's the case that sometimes the smaller banks actually have reserve surpluses because their loan business is not as aggressive as the loan business of the aggressive New York banks, Chicago banks, and banks located overseas. And this is why, to some extent, larger aggressive banks don't have to rely upon their own customers' deposits for their lending activity, because all you need to do, or all you need to have, is excess reserves to be able to make a loan. Remember, the reserve requirement is what the reserve requirement says. We said traditionally it was around 10%, and we use that example in open market operations. So we're saying, therefore, if a large bank that's very aggressive in its lending finds itself short of reserves at the end of the day, they can borrow them in the federal funds market. Now, that market, again, as I point out, is not working very well. It doesn't really quite work this way in 2020 because of the crisis. But this system, during normal times, functions pretty much as I describe it. You may remember we looked at the federal funds target rates and how that has changed over all of these times. This is, of course, the Federal Reserve's target rate. And in some cases, you might even describe it as a control rate, because it's kind of arbitrary whether you put it at the level of target or at the level of control. But at any rate, it is their fundamental objective to try to achieve, and this is what they announce in terms of their intentions for interest rate behavior. And we saw this before. Remember, before we saw how cyclical it was. Early they were trying to curb inflationary expectations and stock market speculation in the year 2000 and shortly after. Then with that recession, they pushed this level of rates down very low. They left it probably too low for too long. Then it had to climb up again because they were trying to curb inflationary expectations, but mostly real estate market speculation in the period shown there between about 2003 and 2006. Then we slipped into the next recession. Down it comes again, and they left the rate essentially at 0 or 25 basis points. This is the upper limit of that 25 basis point range for a very long time. And then remember, under Janet Yellen, they were trying to climb it back up so they could have some interest rate controls. And then this came along, and down comes the rate again to a lower limit of 0 and an upper limit of 0.25, and that's where it currently stands. So this rate, of course, is the rate that they mostly target with open market operations. And it should be obvious that as they provide reserves to the banking system, this rate will be affected by it, because what is being lent on an interbank basis are those reserves. So the more abundant those reserves are, the lower this interest rate is going to be. Now, that doesn't mean, though, that mortgage rates and whatever are going to be rising, but this is supposed to be the way it works. On the maturity spectrum, you have the federal funds rate as essentially a 24-hour rate. That is to say, the loans, in many cases, are just 24-hour loans. This goes all, in the United States, this goes all the way out to about 30 years. There isn't very much that has a maturity of more than 30 years. We have 30-year Treasury bonds. We have a few corporate bonds that go out that far. but mostly treasuries, and not much that goes out past that, maybe nothing these days. I haven't seen anything past 30 as long as I can remember. So they're thinking that if they raise, for example, the federal funds rate at the short end, then as it says here, this is supposed to evoke or provoke a sympathy move or a competitive move at the long end, raising the entire structure of interest rates. Now, to some extent this works, and to other extent it doesn't work. It kind of works a little bit. As we said, interest rates rise and fall together, but the more distant the type of rate from the federal funds rate and from treasury rates, the less likely this activity is to have an effect upon that rate. So, for example, we say the Federal Reserve directly controls the federal funds rate. It sets it pretty much through open market operations, but also by decree. They say, this is our target, this is where we want it to be, and they get compliance on that. That in turn will strongly influence, because of what open market operations are, bank lending rates and United States Treasury rates. That should be obvious. They're buying United States Treasury securities, so the rates on that are going to be affected. They're taking them off the market. This also allows banks to increase their lending, and so it's going to affect bank lending rates rather strongly as well, which, though through competitive pressure, should also to some extent influence mortgage rates, corporate bond rates, especially investment-grade corporate bond rates, various collateralized rates for CDOs and the like, and other private rates. But at times they don't have much effect upon the separated rates there on the far right because of perceived risk or other problems in that sector. Now, for a long time, I've been saying that the Federal Reserve is sort of taking credit for this low interest rate structure that we're having in the United States right now, or that we see in the United States right now. And to some extent, that's valid. But I remind people that before the Federal Reserve System rolled in this reduction of rates, they were already coming down, determined by market forces. So, as Shakespeare wrote, "'Tis many a slip twixt the cup and the lip," when you talk about the effect of open market operations upon these more distant rates that we're describing here. Now, we can kind of address this even with respect to Treasury securities by looking at the Treasury Yield Spreads. Remember this? Now, this is an ideal about how it's supposed to look. This is an example. So we're saying that the term structure of interest rates in normal years, which we don't have right now, rises with longer maturities because of the risk associated with them. So the yield spread normally has a positive slope, as is shown here. That's a normal term structure reflecting higher risk with higher yields. For United States Treasury securities, at least, OMO is working at the front end on short rates, which is usually how they do it, although these days they're buying across the spectrum, should be able to raise or lower the entire spread, although it's possible to also flatten or steepen the curve, sometimes unintentionally. Now, we've been looking at the yield curve all semester long, and let's take a look at it one last time this semester, and let's compare the April 2019 yield curve with the April 2020. I mapped this today. I was actually surprised when I saw it. I didn't realize that right now the shorter term rates are so low, you can see that we don't get up to 0.5% until we get out to the 7-year loan. In fact, we're still below 0.5% right there, 50 basis points. And of course, we don't get above 1% until we get to the 30-year loan. The 20-year loan, as is shown there on the inset, and the 2020 year, of course, is the middle column. The 20-year, not loan, the 20-year Treasury security is 0.98%. So nothing is above 1% except the 30-year bond. And as low as they were last year, this is obviously much lower than that. And this is almost entirely due to the aggressive level of open market operations that we've been seeing since this crisis began. Now, some of you have asked me by email, or have enough insight to realize that this appears to be monetizing the budget deficit, because you've made the connection. You know that when we run a budget deficit, the U.S. government finances that with the United States Treasury, bills, notes, and bonds. And of course, we're running a massive budget deficit this year. And so the U.S. Treasury will probably have to sell up to $3 trillion in United States bills, notes, and bonds, triple the amount it's ever had to sell before. And there has to be a market for that. When we look at open market operations and see that at least indirectly, the Federal Reserve System actually buys them and puts them in their inventory when they conduct open market operations, the question has more or less been asked, is this how you monetize the budget deficit in modern years, in the modern era? The question, how do you play for unemployment benefits at a Great Depression level when you don't have the cash to do it? And the answer is absolutely. This is what is going on. This is how it has to happen. Most of the budget deficit, not all of it, maybe not even most of it, but about half of it will be monetized this year because it'll be purchased by the Federal Reserve System probably. So how it works is like this. It's just a repeat of what we've already said, but we're emphasizing what's going on here a little bit differently. You fund your budget deficit by selling United States Treasury, bills, notes, and bonds. That's never been different. That's always been true, at least in the modern era. So they still have to fund those deficits through the sale of these securities. If the private markets will not buy them, they have to be willing to compete with ever-rising interest rates because of the sheer scale of those operations, or they have to have the Federal Reserve System conduct aggressive open market operations, sometimes indirectly, by having banks buy them first and then buying them from banks, which is mostly what they do. Now, if you think about it, that's what we described as an open market operation typically. The Federal Reserve System pays for the U.S. Treasury securities by making deposits in a dedicated tax and loan account on the Treasury's behalf at a private bank, and therefore, basically, by giving the bank reserves, the bank is able to fund the checkable deposit account of the United States Treasury. The United States Treasury writes its checks out of private banks. They're processed by private banks. And so the accounts in which the cash is held are called tax and loan accounts. And so basically those accounts are built up in cash value. Then the U.S. Treasury can spend whatever money it needs to spend to get things done. So the Treasury is now free to spend that money on unemployment compensation or whatever else. And so this is the modern equivalent of printing money. Now you say to yourself, well, it's not actually printing money literally, is it? The answer is no, of course not. Printing money would be printing these little Federal Reserve notes we carry around in our pocket, $1 bills and $5 bills and $50 bills and 20s and hundreds and all that. That is growing, but it's tiny in magnitude to the overall M1 money supply measure. It's only a small portion of that. Instead, checkable deposit liabilities that become the property of the United States Treasury become the direct consequence of the open market operations, and the Treasury is able to write checks against that. And of course, that also is money, and that's the modern form of money. So that's the sense in which the Federal Reserve System monetizes the budget deficit. And it's a very powerful policy indeed, although it may have long-run repercussions. Here we go back to the macrosim model once again to take a look at this. Remember, we used this once before. We started out with the default economy. Then we decided in the step shown there in the middle, or on the right side of the page, we increased government spending by $660, which is a considerable increase, and that's the same as some kind of stimulating fiscal plan, and we cut the tax rate as well. Now, we didn't cut the tax rate this year, but we cut the tax rate about 3 years ago. And so this is a standard stimulus that has the effect of helping the economy out. And you can see plainly in the model that it does, because you can see GDP rises from 2,800 in our simulation to 3,017. But we know from our previous work with the macrosim models about 5 weeks ago that Interest rates rise in isolation if this happens because that's crowding out, and investment falls, which of course is about the last thing you want if you're trying to stimulate the economy. The budget deficit, more importantly, soars way up with this increase in government spending and the tax cut. In this example, the budget deficit goes from 40 to 149. So remember, we called that crowding out. It results in a huge budget deficit, and we need to mitigate that to some extent. And you probably remember at the very end of those macro sim models, that was fairly easy to do because we used open market operations to accommodate that, as is shown here on this slide that is labeled monetizing the deficit. Here you can see we have kept government spending at a high level. We've kept the tax rate at a low level, but we have also increased the money supply growth rate from 5% to 14%, which we had to do in this model to achieve the desired result. We have an even further stimulus in GDP. It goes from 3,001 to 3,153. We also, however, now have brought the interest rate back down below its original level, which was 4%. Now it's 3.77%. And as a result of that, investment now is at, in the context of this simulation, an all-time high. And that's the potential for monetizing the deficit. We even decreased the budget deficit some, although it's still very large. It decreased because, of course, the stimulation of the money supply caused tax collections to go up higher than it otherwise would have been. But by no means does this allow us to balance the budget. Compare this to the original budget, and this is true beyond this model. And so you can see that if you used open market operations to have the effect of increasing the money supply and decreasing interest rates, which is happening in this model, then that's monetizing the deficit because, of course, we have the money supply very much higher and the credit supply very much higher because of this 14% growth rate. So this is what is going on currently in the U.S. economy. Do we have an unlimited capacity to do this indefinitely? Well, the answer to that is no, we don't. But we can't really comment on this lecture on what might have to be done about this or what the consequences might be, because we have to have the lecture that qualifies these open market operations to what they are today at the present time. Just to give you a sense of it, just a couple of weeks ago, the Federal Reserve System actually reduced the reserve requirement to 0. So the money multiplier is infinite. Basically, this means that banks are free to lend whatever they want because they want the banks to lend as much as they possibly can. And I suppose the feeling is that they'll rein it back in after we have recovered from whatever damage will be done by this pandemic. So that, in a nutshell, is the impact of open market operations upon interest rates. Now, this is all I'm going to ask you about on the actual examination. Again, the qualifying material that comes later won't be on the quiz. So you have now, if you watched this in the previous videos about the Federal Reserve policy, you've covered all the material that is going to be entertained on that quiz. Again, if you're watching this on the day that I posted it, the quiz itself will be posted tomorrow. This is a Wednesday, and that'll be on Thursday. And it'll be posted actually a little after midnight. It runs for 4 straight days, so you can wait until Sunday to take it if you wish. Here's some key takeaways that you should understand from this lecture. We know that OMOs increase the supply of credit and money in the economy, but they also decrease interest rates, and that may be more powerful. Our models, including MacroSim 2, have shown this all along. But now we know how the Federal Reserve is increasing the money and credit supply while lowering rates. They use open market operations, which you should now understand. The key control variable used by the Federal Reserve System is the federal funds rate. And so remember that, and remember what the federal funds rate actually is. It's the annualized overnight lending rate on bank reserves for interbank loans. Interest rates on U.S. Treasury, bills, notes, and bonds are directly influenced in open market operations because they are purchased through the open market operation. Obviously, buying these bills, notes, and bonds in large quantities is going to affect their yields. But other interest rates, though, are only influenced through competitive pressure, which is indirect and doesn't always work. Right now, it's kind of hard to say whether rates are so low because of competitive pressures in a world that is just flooded with liquidity right now, or whether the Federal Reserve System actually wants them all down that low. And also, the mortgage rate, we have to see what happens to that as time goes on. Finally, when huge-scale OMOs are taking place at a time the U.S. Treasury is running huge budget deficits, so if you have large deficits being run with large open market operations, then the Federal Reserve System is at least partially monetizing the deficit. And again, there's nothing beyond the open market operation that you need to understand this. The open market operation itself, in effect, is monetizing the deficit if the proceeds of that operation end up in a Treasury tax and loan account. Well, that's it for the effect upon interest rates. I tried to keep this fairly contained and relatively easy for you to study. So go through this and get yourself prepared and take the little quiz on this. And let's see if we can move on to fiscal policy. That's next.